What if I told you that the trade war with China wasn't just risky because of the reliance that we have on China as a trade partner, but also because of the reliance we have on China as one of the biggest holders of US debt? And what if I also told you that China had the power, potentially, to collapse the US dollar just by selling the US debt that China already owns, and that the consequences of this would be higher interest rates for Americans, higher inflation, and a world where the dollar could lose its status as a global reserve currency? And the scariest thing of all is this might already be happening. China might already be unloading its US debt, igniting what could be a shift to a new world order. In this video, we're going to discuss how China could, in theory, collapse the US dollar, and specifically what happens if China decides to dump US treasuries, along with the economic impacts, the market reactions, and the potential global fallout. But in order to understand this all, we need to start with the foundation, an understanding of how US debt and treasury markets work. And while this is a complicated topic that economists spend years, even decades, trying to understand, I'm going to simplify it for you and give you just the basics, the foundational aspects you need to know in order to understand this potentially massive problem. So let's set the stage by talking about why this all matters. Obviously, China is not the biggest, but one of the biggest holders of US debt. And if they were to start selling off US debt as a retaliation for a trade war, it could cause massive implications for the US and for global markets in general. In fact, it could be the equivalent of a financial earthquake, one significantly more severe than what happened in 2008. It could not only cause a collapse in the US dollar, but it could also cause a collapse in global markets, something worse than anything else we've ever seen before, more in line with what happened during the Great Depression than what happened during the financial crisis. And the scary thing here is that compared to 1929, today, economies are significantly more tied than they were before. And subsequently, trust is significantly more important, which is why what's going on with the US and tariffs is so disturbing. Because the US has always, at least for the last 100 years, acted as the most reliable trading partner on the planet. But today, things are changing. And the fear is that US treasuries and US debt could be weaponized. So to start, let's talk about what US treasuries are. Because treasuries are basically IOUs that are issued by the US government. Investors in other countries, they lend the US money in exchange for interest. Well, kind of. Really what happens is that the US issues bonds, and they put them out on the market and say, who would like to buy these? Now, these treasuries, because the US is the world's most reliable trading partner, are very secure. Reliable economy, reliable debt. This is the type of thing that you are almost certainly going to get repaid on if you invest in it. And as opposed to a typical lending-borrower relationship where a borrower has to qualify with the lender in order to borrow the money, the US simply puts these out on the market and investors compete in order to buy them, with the expectation that over time they're going to receive interest in return, and at the end of the term of these treasuries, they're going to get their money back. Now, keep in mind the piece about getting their money back because that's going to become important a little bit later on. Now, these bonds, they typically go towards funding government spending. Things like government programs, military spending, government spending, basically anything that the government spends money on. The things that are in the budget that ultimately cause the deficit, which creates debt. More specifically, the US national debt, which we'll talk about a little bit later on as well. But the question is, who owns this debt? And while many people think that China is the biggest creditor of the United States and that we are therefore beholden to China, that's not necessarily true. Yes, China plays a pretty important role in our debt, but they aren't the only player. In fact, the biggest player when it comes to the US national debt actually isn't anybody who lives in a foreign country or foreign countries themselves. It's actually the American people. Because when you look at who the government owes money to, the majority of it isn't to other countries. The majority of it is to Americans. 48.8% as of September 2024 is to US individuals and institutions. Another 12% is to the US Federal Reserve. And then another 7.3% is to the US Social Security Trust Fund, and 4.5% is to US Military Retirement Fund, and so on. The US Civil Service Retirement Fund is about 3%. Then the remaining, about 25%, is held by foreign governments. Now, Japan is the single biggest holder of US debt. China and Hong Kong, well, they're number 2. And then various other countries hold the rest. But the question is, could one player, China, Japan, or a combination of these players, bring down the US economy, the US dollar, and essentially destroy what is the current world superpower, especially when it comes to economics? And the answer is, well, maybe. The US has over $36 trillion in debt, and this is growing at a rate of about 7% per year. Of that debt, foreign countries hold about 8.5 trillion of it. And this debt continues to grow as the government spends more than it brings in. So if they're spending more than they're bringing in tax revenue, the debt goes up. And that's what has consistently been happening since 2008. Now, in the late 90s, there was a lot of bipartisan cooperation on bringing down the debt. Both parties got together, decided that this was something that needed to be done, and for a time, there was actually a budget surplus. And the US national debt was not growing, it was actually shrinking. This was during the late George Bush Sr. and Bill Clinton eras. But then 2008 hit, and obviously something needed to be done to save the economy. It could have been way worse than it was if the government hadn't stepped in and ratcheted up spending in order to save the economy. And this again happened in 2020 with the pandemic. Government stepped in, spent the money that it needed to spend in order to save not just the US economy, but the global economy. And it's important to understand how important the US is in the global economy. Because unlike 1929 and the Great Depression, where countries were more or less self sustainable with some trade back and forth, today countries rely heavily upon each other. And if the US or any other big economy were to go down, it could have drastic effects for everybody. And the US has always been reliable. It's been a reliable economy. They always pay back their debts, which has made US treasuries the safest asset, one of the safest assets in the world, backed by the US government. And as a result, these become the thing that all other interest rate things are compared against. So, as an investor, you have all kinds of options on what to invest in. You can invest in bonds, you can invest in stocks, you can invest in mortgage securities. But when it comes to the interest that we pay as consumers on things like credit cards, things like mortgages, things like car loans, quite often the decision that the investor is making is between that of a US Treasury and that of something that is a little bit more risky. And as a result, the more risky investment, something like the car loan, something like the mortgage, something like the credit card, it comes with a premium. So you as a borrower pay a premium over and above what the safest possible thing that that investor could invest in, which is US government treasuries. So when the price of these treasuries shifts, so too does the interest rates that consumers pay for things. And this has a pretty significant impact on the economy, which is why the US needs to be careful how far they go with this trade war with China, because China does have the ability to play with the bond markets and ultimately affect the US consumer. So let's talk about China and their relationship to the US when it comes to the bond market. So, first, we need to understand why foreign countries buy US bonds. Well, we already talked about the fact that treasuries are considered one of the safest investments that a country can make, or any investor for that matter. And while the returns on these bonds are small, they're reliable. It's a sure thing, it's guaranteed, which makes them the perfect thing for countries to use to store their wealth. But in addition to that, they can also use US bonds, US debt, to manage their currency values. And the way this works is actually kind of interesting because you might have a country like China, who back in the day was seen as an unreliable trade partner. And therefore, countries didn't want to trade in their currency. So they traded in US dollars instead. Now, eventually over time, countries may have been more willing to trade in the Chinese currency or in other currencies. And that can be partially because they start to see that country as more reliable, or it could be because that country has a whole bunch of stuff that backs their currency. Stuff like US debt, the most reliable investment in the world. So the fact that China started to store a lot of its wealth in US debt, essentially US currency, that made their currency stronger as well, because other countries knew that it had some backing. Now, when it comes to the US-China trade relationship, keep in mind that the US imports a massive amount of goods from China. And guess what currency that the US pays for those goods in? It's US dollars. So China earns the US dollars through this trade. And subsequently, it can use those dollars to buy goods from other countries, import things, or if it has more US dollars than it is actually spending, it can take that money and turn it into US treasuries, an investment, a reliable investment. And this is why China holds over $700 billion in US treasuries. It's because they have so much available US dollars and they need a safe and reliable place to park it, which is what they do. And not only that, like I mentioned before, it has the unique side effect of it helps stabilize the Chinese currency. And when that Chinese currency is stable, it keeps Chinese goods cheap. In fact, this is kind of one of the conversations that many people are having about the US-China relationship, is that China is artificially keeping its currency cheaper in order to make Chinese goods cheaper so that there's more demand for them. And part of that mechanism is actually using US treasuries in order to do that. But it's also quite simply just safe storage for their money. And this is why the relationship between China and the US is so precarious. It's like China holds a whole bunch of US debt, but they're also kind of adversaries, and this creates a very precarious position. Which, if everything is fine and everything is good and everyone loves each other and nobody is fighting, is totally okay. But the second that that turns, it gives your biggest competitor, your potential military competitor, the power to have an effect on your economy. That's scary. And it's even scarier when you recognize that China does hold about $760 billion in US debt. And they've started to hold less and less US debt over the years. But that doesn't mean that they don't still have massive influence in the bond market, and also the ability to essentially play almost pseudo central banker for Americans by being able to potentially manipulate interest rates in the US, even though all they're doing is selling the US bond holdings that they currently have. And just for interest's sake, this is the record, the history of US total bond holdings. You can see that it went up quite substantially after China joined the WTO in the early 2000s, only to start falling recently. So here's where things get really scary: the fraught equilibrium. At a time where trust with China has seemingly never been lower, many people are scared that China is going to weaponize its bond holdings. And this fear is actually what's driving a lot of the stuff that's going on with the trade war between China and the US. However, if China were to divest itself of bonds and do it quickly, it could be catastrophic not just for the US, but also globally. And it could have a pretty significant fallout for China as well. Because even though these countries are seemingly adversarial right now, Beijing and Washington both have a vested interest in making sure that US bonds stay valuable. Because if they didn't, this could affect about a third of China's foreign currency reserves. The question is, knowing this, knowing that it's mutually assured destruction, at least economically, is China willing to go so far as to use the nuclear option? So let's talk about the hypothetical shock. What happens if China dumps US debt? First, we need to understand the relationship between bond yields and prices. So, for example, let's say you were to buy a $1,000 bond, and that bond paid a 5% coupon rate. In exchange for buying that bond, you would be paid $50 per year. Now, let's say that the value of those bonds went down because, I don't know, people weren't as confident in the US government anymore. And let's say it dropped to $900. Well, the person who bought that bond would still get the $50, the coupon rate off of the original value, but the return would actually be higher. It would be 5.56% because they were able to buy the bond from you for a cheaper price than what you paid for it. Now, if China were to dump all of their bonds or a large portion of their bonds onto the market, that would create an oversupply, meaning that the prices of the bonds would go down and the yields on those bonds would go up. Now, where this becomes problematic is if the US has to reissue bonds, which it does on a pretty regular basis. Because now the new bonds that they issue for $1,000, they're going to have to offer a higher interest rate to compete with the bonds that were sold for $900 that now have a higher yield. And this translates through the entire economy. Higher mortgage prices, higher car loan prices, higher credit card prices. The interest rates on pretty much everything associated to debt would subsequently go up as well. Now, what happens if you take this and you make it a bigger scale? Let's hypothetically look at a scenario where China were to dump $500 billion in treasuries. This would obviously cause bond values to drop. In return, the yields would go up, the interest rates would go up. And this would be what we would consider a rare, drastic move. And in other words, it would be the Chinese nuclear option, the thing that takes down the American economy while potentially taking down their own. Now, I asked ChatGPT what would happen. It did a bunch of research, looked at previous bond shocks, and it came up with this scenario. If China were to dump $500 billion worth of treasuries over the course of a month, it created these estimates. Now, these are nowhere close to correct. But what I want to point out is this. While it did in fact predict that interest rates would go up, the thing that it got wrong, especially when you consider today's scenario, is that it assumed that the US dollar's value would go up, which, as we all know, It hasn't, at least not with this most recent bond sell-off, which, by the way, nobody knows if this is China, maybe it's Japan, maybe it's other countries that are just going, this whole thing with the US is crazy. They aren't reliable. We don't know what to do, so we don't want to hold their debt anymore. But what happened recently when there was a debt sell-off was this. We saw bond yields spike more than 0.5%. And I'm not even sure that there were $500 billion worth of bonds sold. But in addition to that, the value of the US dollar, well, it didn't go up. It actually went down significantly. And this makes goods that are brought in, that are imported, even more expensive. And they're already more expensive because of the additional tariffs. The weakening of the US dollar is making them even more expensive over and above that. So let's talk a little bit about how China would do this debt dump if they were to weaponize US securities. Normally, countries, if they're going to sell bonds, they're going to do it gradually over time. I mean, we've seen this. We've seen China gradually, slowly sell their bonds and have less and less holdings in US debt. But in this scenario, what if they were to sell aggressively, to sell fast, with the goal of destabilizing the US economy and the dollar? What would the repercussions be? Well, first of all, it could undermine China's own investments. The reserves that they have in US dollars largely supports the value of their currency and their economy as well. So this could have a negative impact on China. But in addition to that, the selling of US treasuries could actually strengthen the Chinese currency. And the downside of this is that actually makes their goods more expensive, less desirable on the open international market. So weaponizing US treasuries would actually have a negative impact, or at least potentially have a negative impact. They don't want their currency to be stronger because they want their goods to be the most competitive goods on the market. And this is why in a lot of cases, the US and other countries have accused China of artificially lowering the value of its currency, because that is a benefit to them. And selling US treasuries off and making their currency more valuable would not do that. And as a result, this would all be self-damaging in the long run. But all those foregone conclusions ignore the fact that China could have real reason for doing this. Obviously, it would be a way of retaliating against US sanctions without raising tariffs that essentially at this point don't matter. Once you hit a certain point raising tariffs, the damage is done. And once trade goes to zero, raising tariffs doesn't matter anymore. So then it becomes, what are the other tools to fight the trade war? Well, this very much could be one of them. Then there's the fact that if they got rid of the US currency, they could, in theory, reduce the reliance on the US dollar. But one important thing to note about this that we'll talk about later is that also reduces their leverage over the US economy. So while weaponizing US treasuries could be a way to create an impact really quickly, it also eliminates the future leverage that they could possibly have. And last but not least, this could force a shift in global economic power towards China. The nuclear option, where you destroy the US dollar, destroy your own currency, and make the global economy worse off, could be the thing that gives you a head start when it comes to rebuilding, and ultimately could put you ahead of the competition. It would basically be like saying, you know what, we're going to blow the whole thing up and we're going to see who comes out on top. And if China, for whatever reason, really believed that they could come out on top, this could be a really real thing. But this real thing would create a real domino effect because it would have serious financial consequences for the US and for pretty much the global economy. But let's talk about what would happen in the US. First, you'd see this flood of bonds. The bond prices would go down. Lower prices equals higher interest rates and higher yields, and borrowing would get more expensive across the board. So we've already seen the tariffs. That's making things more expensive, especially things coming from other countries, but also making things that are made in the USA more expensive because the goods that are used to make them come from other countries. But then the ability to buy those things gets more expensive as well. And the people that would feel the most pain are the US consumers. Mortgage rates would go up, car loans, credit cards. We've talked about this already. But what we haven't talked about is the fact that people would borrow less. And when they borrow less, spending slows. And when spending slows, that becomes contractionary, or in other words, recessionary. And it would be the everyday Americans that would feel the pressure. Then we'd also see shockwaves through the stock market. So normally when stocks are going down, bonds are coming up. Right now, because of the uncertainty in the markets, we're seeing for the first time since 2008, bond markets falling while at the same time the stock market is falling. And if it became clear that China was in fact weaponizing the US dollar against itself, we could see the sell-off start to accelerate. And this would cause massive losses, huge losses. Maybe to the extent of 90%, like in the Great Depression, maybe to the extent of what happened during the financial crisis, nobody knows, but it could be bad. Millions, billions, trillions of dollars would be lost in retirement funds and portfolios. But here's where it gets really scary. The currency turmoil. The dollar falls. Because China selling treasuries is like China selling US dollars. And when there is an abundance of supply, the value goes down. And this is what would weaken the dollar against other currencies. And it's what would make imports more expensive and cause a significant amount of inflation. And we've already seen this. After tariffs, the dollar's weakened instead of strengthened. Tariffs were sold as this way to make the US great again. Well, it's making the dollar less great every single day. And the worse this gets, the more likely it is that the US's dominance will be brought into question. And if that happens, if the volatility gets worse, well, now we're talking about a new global economic superpower, which is obviously the worst case scenario. So how could the US respond? Well, let's talk about what the Fed might do. The Fed could step in and be the buyer of last resort, taking these bonds off the market and propping up prices to keep bond yields low. In fact, they may very well have to do that if there were to be a sell-off in US Treasuries. Because a sell-off in US Treasuries would essentially cause higher interest rates, and the only way for the Fed to combat that, and keep in mind that the Fed's primary role is to combat inflation, which their primary tool is interest rates. So having higher interest rates could create a problem. Well, if they're not the ones who are controlling interest rates, and it's foreign countries that are, the Fed has to step in, start buying those bonds, and do what it needs to in order to maintain control over interest rates so that they can do their job and maintain control of the US economy. Then, in addition to that, they may have to pump money into the economy even further. And this is all money printing, providing liquidity to banks and credit markets. And ultimately, in all likelihood, they'd probably have to lower interest rates to calm the storm, even if inflation was on the rise. And this is what we learned in 2008 and during the pandemic is quantitative easing. The Fed digitally prints money to buy bonds. It helps prop up the bond prices and keeps yields under control. And this is the tool that was used heavily in 2008, heavily in 2020, and would probably be the first tool that the Fed moves to if we had to do it again. Albeit, this is not something that the American people have an appetite for. Printing money in the minds of Americans right now, whether it saves the economy or not, is not good. And with a populist president, it could be something that the government doesn't have an appetite for either. Now, with respect to the global financial markets and the reactions there, we could see money flock to gold, Swiss francs, Japanese yen. And this isn't necessarily a good thing for those countries, those currencies, and those assets, because it may hurt those countries, especially from an export perspective when their currencies become more valuable. And also with respect to the fact that they hold significant amounts of US dollars in their reserves. And this leads us back to that 2008 financial crisis scenario where when one domino falls, the rest of them could fall as well. So more than likely what we would see is central banks start to work together and start to coordinate in order to maintain the value of the US dollar, in order to make sure that the single currency that the majority of the world uses to buy goods doesn't collapse overnight. And we saw this when the world transitioned from the British pound over to the US dollar. Other countries had a vested interest in making sure that the British pound didn't fall too fast. And this global collaboration would be essential to make sure that the absolute worst did not happen. And that subsequently would lead to risks for China. This isn't a play that China can make without serious risk of repercussions, because China's economy would feel the burn at the same time. This nuclear option not only hurts the US, it hurts China as well. And they would have to decide if the risk is worth the reward. Dumping treasuries would drive the value of their currency up. That means exports are more expensive. China is an export economy. If the value of their currency goes up, that's going to create fewer orders of goods. That means less jobs. And that means a shrinking economy. And not just shrinking with respect to the amount of exports that they provide, but also a homegrown economic recession that would shrink their economy as well. But not only that, selling all the bonds and creating the crisis would be essentially the equivalent of selling low, unloading investments and losing money just because you feel like it. And their remaining treasuries, the ones that they haven't sold yet, well, those are going down in value as well. And this would lead to billions of dollars lost not only on paper with respect to their holdings, but also in potential revenues. But in addition to that, there's a political fallout as well. Other countries may start to distrust China because they're weaponizing their currency and other currencies in order to penalize other countries. In fact, we saw this happen with the US when they penalized Russia. All of a sudden, other countries around the world, the BRICS nations, they started talking about an alternative currency so that the US didn't have the power to essentially penalize bad actors. They didn't want one country to be in control of global trade, and to be able to have enough power to hurt the economies of countries that didn't do exactly what the US wanted. And other countries probably don't want China to have that power either. And this may lead foreign investment in China to pull back. Countries may no longer want to do their manufacturing there. They may not want to build the facilities necessary to build things like iPhones and parts for Teslas there. And in the same way that the US is isolating themselves, which is leading to this whole problem, China would become isolated as well. And more than likely, what we would end up with is either a bipolar or a tripolar world, one with Eastern countries, Western countries, and potentially the US as an isolationist country as well. So all of this is strategic in nature. What China does really comes down to what they believe will happen if they do it. And this is all strategic. Are we willing to go to war with the US in order to create a new world order? And there's no easy exit strategy here. Other assets can't absorb China's reserves, the ones that they would be selling on the open market. If they were to overbuy euros or overbuy gold, that's going to create bubbles or spikes in prices that makes things more expensive and those reserves less likely, which makes treasuries still the obvious and the best option for not only China, but pretty much every other country out there. So any strategy with respect to the selling of bonds, the dumping of bonds, would likely backfire because the US can buy these bonds back. It can offset the impact, at least to some extent. And other countries are their trading partners, and let's call a spade here. The US and its allies are significantly bigger economies than all of the BRICS nations and all of China's allies combined. So they would likely have some support, assuming that they didn't kill their relationships with all those other countries, which, by the way, they actually might have done by putting tariffs on all of their best trading partners. But it is possible that the dollar may bounce back after an initial shock, meaning that China would go to war only to find out that not only had it gone to war and lost, but in addition to that, it lost all of its leverage because it no longer had all this debt that they could use as leverage against the US when it came to their trading relationship. So the big picture here is this. This is all about global currencies and trust. Who trusts who, who's reliable, who's not. The US has an obligation. It's in their best interest to remain the most trustworthy country in the world. Right now, that's not what they're doing. They need to bring this back so that other countries and investors continue to trust them. And unfortunately, I think this is going to take some time to rebuild that trust. They lost the one thing that their entire economy is based on. And it's so important to understand that over half of all global reserves are in US dollars. Oils, commodities, global trade are priced in dollars. And the dollar is still the most trusted currency in the world. And it's important that it remains the most trusted currency in the world. It's important that the US doesn't use its power in order to ruin the relationships and bully other countries. What Donald Trump is doing with tariffs right now, love him or hate him, is wrong. It is bad for the US, it's bad for China, it's bad for the entire global economy. Now, there are things that Donald Trump is doing that are actually good for the economy as well. But these tariffs, this trade war with China, that could potentially cause them to invoke the nuclear option here, and I'm not talking about the one with bombs, is bad for everybody. It's absolute insanity. And I'll link to a video at the end of this that talks about the person that's behind this whole trade war and how he's essentially a Harvard economist that other Harvard economists think is crazy. But this isn't the 1870s. It isn't the 1920s. The global economy is now an interconnected web. And when countries aren't fighting, when we're at peace, this is a good thing. The US and China right now are economically codependent. And it's arguable that this isn't a good thing for the US and that maybe the US should be less dependent on China. But the way you do that is not all in one shot with tariffs. You do it gradually. And you do it in a way that China sees it happening, but doesn't see it happening overnight. Because if the US hurts China, it hurts the US. And if China hurts the US, it hurts China. That's the reality here. This is not a win-lose situation. It's definitely not a win-win situation. Any conflicts between these two countries are literally a lose-lose situation. Everybody loses. It's what's called in economics a zero-sum game. And just like any other financial warfare, there's very rarely winners. And what's worse is oftentimes these turn from economic warfare into military warfare, which is a whole conversation that I'm too scared to even talk about. So while China does have the power to cause some damage to the US currency, it's likely something that the US and its allies could manage. It would essentially create short-term chaos, not long-term economic damage. That's assuming that the US continues to have the tools and the allies necessary to combat it. And if it does, it would make China highly unlikely to actually do something like sell off bonds in order to hurt the American economy, because doing so would hurt themselves. But the most important thing here with respect to the US versus China conflict is the trust needs to be rebuilt. And if it can be rebuilt, we can go back to normal with freer trade, stronger economies, and a global economy that is significantly better off than whatever it is that the US and the Chinese governments are doing right now. Oh, and by the way, all of this stuff is absolutely crazy. But if you want to know more about just how crazy it is, make sure you check out this video on the madman who's behind Trump's trade policy.